Hey, hi, hello, how are you? I hope all is well. I'm just going to chuckle into the intro now. Um, this week's topic is going to be the GameStop stock opportunity. And if you're anything like me, you did not get into the action. You did not hear about it until it was already national news. I don't day trade myself. I'm just an engineer. um, uh, and so I didn't actually land on the opportunity until it was already blown out of proportion and made a national story. But that didn't stop me from feeling a little bit of investing FOMO, if you will. I was racking my brain a couple of days this week at least. I'm sure a lot of people were saying, should I go in? Should I not? Should I jump on the bandwagon? Should I not? So I thought it might be just helpful to list out like what my thought process was in like deciding whether or not to jump into that opportunity, and like how I came to the conclusion that I did. So let's jump into it. I have like this three-step process that I used to judge the opportunity. Okay, let's take a look here on a little flow chart. Since this is a business topic, we need a business diagram. I'm just grabbing this from draw.io, which is my favorite way to map out things. A point of order, if you do hear Eddie in the background, this is Eddie in his very relaxed state, in his very chill state. Right now, he is protecting the house. We just had some neighbors moved in behind us who have two dogs, and I let all the windows open just to get some fresh air in the house. So you might hear him periodically through this video doing his protector status right now. So after cruising the business type diagrams, I don't really go to the business side of the house. I usually stay in the engineering realms. We found this cool little Venn diagram. So this is going to help us explain our point. So we're gonna call this opportunity, and we're gonna zero out everything else. So we can start with a kind of like a blank sheet here. Now, this isn't a fully fledged out thought. Um, I kind of was about to go off the deep end last week and dump some reserves into the stock, and I took a break, took a step back, and then reevaluated the opportunity, and then came out with this kind of this workflow of how to like gauge investments moving forward. So this isn't original material by any means. There's tons of online resources that you can go to. I'm reading a book called, well, I say reading. I'm listening to a book called I believe it's called Algorithms for Everyday Life. Let me pull it up on Audible. Yeah, Algorithms to Live By. I'm currently like listening to that book by Brian Christian and Tom Griffiths. I will show it on the screen. So they talk about some interesting like ways to view decision points within your life, or just look at how like different frameworks work for your everyday walking around, can actually play into everyday life and help you make like regular human decisions. And then there's also a YouTuber that's extremely good at breaking down like complex or just financial topics in general into plain English. And his name is the Plain Bagel. So I would definitely give him a follow and listen for any financial things. That is a key point. I'm not a financial advisor. This is just how I came up with the decision I did to not go ahead and invest in the stock market this week. We found this business Venn diagram. We're going to put opportunity here in the middle, and then we just zeroed out the rest. I'm probably not going to fill out this entire thing because this is just a quick summary of how I came to the conclusion I did. But so for this first bubble, we're going to call this timing. So by the time I heard about the opportunity, I had woken up. I forgot what day it was, but I had woken up, and my engineering friends were already texting me saying, "Hey, did you?" My engineering and gaming friends were already texting me saying, "Hey, did you hear about GameStop? Oh man, GameStop!" And I like made breakfast. I had gone and I had worked out. I had like logged in, started checking stuff for work, and that's kind of when I popped open the page to see that the stock had gone from nothing to over $300 per share. So right there, you could see timing. I was not like there's different levels of timing. I wasn't ahead of the curve by any means. I was kind of like maybe in the midpoint. Who knows how far it would have shot up. Or I was late to the party. So right there, we could say like mid to late to the party. And that's just a good financial tip in general. If you're hearing about the opportunity, about a opportunity of a lifetime from social media, generally those aren't good or those are at least late. You know, the early movers have already gone in and you're just kind of sitting there jumping on a bagwagon. I don't know what a bagwagon is, but you're riding an opportunity that has already been presented. So you're already pumping something that, you know, people that have gotten in early want you to pump. So that's kind of the first circle of the Venn diagram, is the timing of the situation. I'm just gonna say I was kind of late to the party here, but you know I wasn't sure because there was all these comments, messages of like go to 1,000 for it. So they still could have gotten in at the time if I had wanted to. The next, so we're gonna call this investment because this is actually opportunity. Yeah, it's fine. So by opportunity, I mean that do I have the ability to move on something? Like if the timing was right, what was my current capacity to actually engage and move on this market trend? And one thing to know is I had liquid assets available to me. Like so. But what I mean by this is I had, you know, investments. I could have moved money around. That would have taken a couple of days, like a couple of business days. And by then we would have already been blocked out of our timing metric here. Of course, the option at the time was to use Robinhood to go ahead and invest. But we all know now that you're in the future and I'm in the future, we all know how that worked out. At the time, though, it was still an available option. So the third option here, we're going to call risk. Now, nobody likes to talk about risk, especially when you're talking about day trading in the market, but risk is a real big thing. At the time, I had gotten in, I had seen the opportunity, saw that I could maybe take advantage and jump in. Let's take the first two and say that they were givens. I was in, I had time and I had opportunity. I could have moved. Let's say I could have moved some cash around and gotten it into the account. Well, the last little circle here was my risk factor. So right now, I bought a house basically 6 months ago. And every month that I have been living here, I've been putting extra principal towards my mortgage. The reason why I'm doing that is for the first 3 years of your home loan, of your mortgage, is the largest percentage of interest that gets applied over the course of your entire loan history. So I'd have to run the numbers just to be sure, but I think it's like a 70-30 split where 70% goes to your interest, 30% goes to your principal. So every single dollar you send out towards your mortgage automatically gets applied like to knock down that interest. So that's not the same in the stock market. So what I mean to say is I have two choices of an opportunity. One was to go into this bet on the stock market that it would keep going up, and sure, there you could say that the risk tolerance isn't 50%, but for my limited knowledge of investing, it's basically a coin flip for me. This is a momentum move, momentum play. It could go to 1,000. It could go to 0. As far as I'm concerned, in my knowledge, in my limited knowledge base, I had no idea. So it was basically a 50-50 risk percentage for me. And that's not to say that that's true. Somebody that actually understands what they're doing, and knows, somebody that is a financial day trader could argue that risk percentage and explain how it's not really a 50-50 shot. But for me, it is. So that's like went into my calculation, my decision matrix. Whereas, so when we look down here at the risk factor, we have the stonks, as they're called, that I learned this week. It was basically a 50-50 shot for me. I'm not sure. I'm not a day trader by nature. I just have a very simple investment plan currently, and I have a very focused plan. I got out of debt. I am taking the money that I do acquire every month, and I'm putting it towards almost sure things right now until I knock out my mortgage and secure that portfolio. I'm kind of going down the boring track, if you will, but I'm trying to do better with everything that I have, and trying to learn all these things on the fly. So taking the two opportunities, taking my, like, let's say extra 1,000, or I could have reallocated some assets. Which would I apply it to? Would I apply it to the 50-50 shot over on the stocks? Or would I apply it to my mortgage, where I'm guaranteed a 10x on it? Now, I understand that there are many people that made tons of money on this situation. But if we take all three into account, the timing of the opportunity, I felt at the moment that I was a little late to the party. The opportunity that was present there, did I have any liquid assets to move? Not really, because I had been sending all my extra cash over to my mortgage, and in order to move any assets around, that would have taken me 2 to 3 days, so I could have been out of timing, or the risk factor itself. So for me, without any real day trading experience, I'm calling that a 50-50 shot. If I do learn that wasn't the case, and I do some more research, I could come back at a future opportunity later and maybe make a better decision. But for right now, I'm calling it 50-50, or my other opportunity that I had on the table, which was my mortgage. So I guess we could put mortgage right here, or mortgage 10x, I'll say, because that is a guaranteed 100% truism based on the type of mortgage that I have. And I'll have to run the numbers on my amortization schedule just to make sure that is correct. But that's how I understand. That's how I understand it. So I hope that was helpful. That's just how I made the decision to not. That's how I justified not having extreme FOMO this past week, when I'm, hearing everybody go, "Oh man, I'm doing extremely well. I'm 300xing or 3,000%ing this opportunity." I'm extremely happy for the people that took the opportunity, had the right timing, got in early, got their, had the assets to actually make out on this deal, and came away with some awesome returns. I'm super happy that happened. But for me, for my opportunity, for what's going on situationally in my investment life, I think I made the right move here. But let me know. Throw down in the comments. How do you feel about what's going on currently in our financial markets? Did you go in? Did you not? Was there any other opportunities that you felt like we're missing out on? We can kind of run through the scenarios and see where we're all at. But I hope this has been enjoyable. I hope this has been enjoyable for you. Let me know how you feel, and I will see you in the next one.